All right, well, good morning again. And I promised somebody, at least, that I would do a video on bond discounting. So I had a practice assignment. I think it's called assignment 6, maybe? I don't remember. But anyways, it was just something I had made up for a different class, sort of. And what it is about, so right now, interest rates are going up. I think they just hiked them another some odd points. It's up around 4%. So that's the discount rate. So that's the Fed funds rate is set by the Federal Reserve, which has the monopoly on printing of U.S. currency, i.e. the dollar, U.S. dollar. And so they set those rates, and for 40 years, going back to 1985-ish, they had up to 90, somewhere around there, interest rates had been falling. So if you were to look at them, they had a spike. They hit their peak in 1984, 3 somewhere, and that was called Paul Volcker's years. And that was 1970s. We had inflation that was at an all-time high. Of course, inflation today is, if you measured it in the same way, it's actually higher today, or about the same. Now, because they changed the measurements called hedonics, they say, oh, the price of beef is going up. People must eat more chicken. So let's take beef out of our basket of goods that we use to measure inflation. We'll put more chicken in there. And so anyways, they do all kinds of things to funny the numbers, but interest rates were jacked way up to cut inflation. That is like basically wreck the economy, real estate depression of the 1980s. And so then, but since then, interest rates have kind of gone up and down, but they have a general trend from almost 20% to basically zero. And they were at basically zero from, they were during the housing boom, and then they went up and the housing bust. So they came back down. So they've been at pretty close to zero for a very long time. 2018, they started to tick up a little bit, but the housing market came down, it just started to come down, and so they dropped rates again, and that brought the housing market back up. And then we've seen over the last few years, housing market has gone completely mad, I say, right? And that's because interest rates have been pretty close to zero. Now, obviously you don't pay zero, you pay about 3 to 4%, but that's because you take the basic Fed funds rate and then you add whatever the bank has to do to basically survive, right, and profit and so etc. And so interest rates have gone up. So they've gone from 0 to about 2% in a short period of time. That is about a year, right, which is considered a short period of time. And so interest rates are continuing to go up, and what we're seeing is housing is flatlining. So it's about 2% down over the in August, I think it was the number I saw, 1.7 or something, 2%. And houses are remaining on the market significantly longer. So if you go back a year, you put your house up, like as you're pounding the post in, you're getting flooded with offers, right? And so, I mean, I knew people that literally did that. They put the post up and somebody stopped, and I've heard stories about this. And houses sell in a day, no problem. Today, that's not going to happen, and it's because interest rates are much higher. So in fact, the number, if you had a mortgage from, let's say, a year ago or back, your average was about 3 or 4, I think 4%. And if you got a mortgage now, you on average are going to pay 40% higher interest rate. Now, what that means is your monthly payment is going to go way up. Okay? So there's a formula to figure out your monthly payment, but if you wanted to very simply do it, take the $1 million. In fact, I had some examples of this, but if you were to take whatever you're purchasing, basically double it and divide that by the 30-year, 360 payments, that tells you about how much you'll pay every month. That's just like a very, very simple way to do it. As interest rates rise, that increases, of course. But we do have a payment schedule. There's a formula there, and I actually have it in this book here as well. This is a book I have. In fact, I think I have it right here. No, this is Half-Life Formula. Anyways, it tells you, given certain interest rates how much your mortgage would be. And it's the idea of pay. It's because every month let's say you buy $1 million home and you put 20% down, so that's $200,000. You have an $800,000 debt, and every month you're paying 1/12 of your annual rate in interest. And so for the first 10 years of your mortgage, you're paying about 2/3 or more of your payment is interest payments, right? Over time, you slowly notch away at the principal, which is the 800,000 you get. But anyways, so all of that to say, interest rates are going up. And what that means is bond values from bonds that have been sold last year are going down. And it's because if I'm going to go onto the market today and I've got $1,000 and I want to go buy a bond is a debt instrument. It means I go to a corporation or something and I say, here's $1,000. You give me a IOU that you're going to make monthly payments to me. Could be annual payments, but it's monthly payments. And you're going to pay, I have $1,000, and let's just say that interest, it would have been maybe 2%, right? So $20 a year on that $1,000, okay? That's really nothing. So $20 a year, payments, you divide that by 12, it's less than $2, right? Now, if I go out today, that 2% bond is now 4%. So now instead of getting, let's just say $1.70, again, my calculator here. So we'll say 0.2 divided by 12 is the monthly interest rate is 0.167%, okay? And so if I have $1,000, that's about $1.67. Okay, so I said $1.70. It was very close. Okay, now I can go out and get a bond at 4%. So do I want a bond pay me $20 a year or $40 a year? If I had $1,000, which one would you prefer? Obviously, you're going to take the $40 payment, right? The bond that pays you $40 per year. It's the same price. And so in order, if I have that $1,000 bond at 2%, I need to somehow incentivize people to buy my 2% bond that's $1,000. And it's because at the end of the period, could be 10 years or something, you're going to get your face value return, right? So it's $1,000 bond, a face value of $1,000, but if the interest rate is below what the going market rate is, the value of that bond has gone down. So as interest rates go up, bond values of bonds in existence in the market already go down. And the reason is, again, those monthly payments, I could go out and get a brand new bond from a company today at 4%, and they're going to pay me $40 a year, which is $3.40 a month, which is not much, but it's better than $1.67 per month, right? Than $1.70 per month, say. Okay. So if I had to pay $1,000, like I'm definitely going to take the bond that pays me twice as much per month or per year, whichever one you want to do it. So if I had to pay $1,000, so in order to get me to buy that bond that pays a lower value, you got to give me a discount on that thing, right? And so there's a formula, and it takes into account what's called future payments. That is, suppose it just pays annually. It's going to pay me, say, $20 per year. So what is the present value given a 4% interest rate of $20 1 year from now, 2 years from now, 3 years from now, right? So I had a little schedule on there that explains how that's done. And again, this comes to the idea that people care about the present more than they care about the future, which is rational, right? A reasonable, because after all, the future, theoretically, the future never comes, right? But a year from now is less important to me than today. And the reason for that is today actually exists. A year from now, I have no idea whether it's going to exist, what it's going to be like, right? Where I'm going to be. I really don't know that much. You could go 10 years down the line. I might not be alive, right? So there's the further out you go, the higher probability of me not being around. right? So that's why we discount the future. And so when you're looking at future payments of various bonds, you're comparing them, you're discounting those future payments according to the going interest rate, right? 4%. And we'd also, in general, people discount the future at various discount rates that are personal. So it's kind of like, hey, if I told you, hey, I'll give you $100 today, or I'll give you maybe how much would it take for you to wait a year, and I'll give you some amount. And let's say you said, oh, I could $100 today, but if you give me $200 a year from now, then I would be willing to take that over the 100 today, and that means you have a 100% discount rate, right? Or you say 50% really, but you're discounting the future by about half of what you are today. So $100 today, or 200 in the future. So today is worth half. The future is worth half as much, and so you want to be compensated by getting twice as much in payment to make you wait, right? And so it's on and on it goes. Just checking the date. I'm always checking the date because Rob Schneider tickets tomorrow. Rob Schneider's in town. He's at the EQC in Tacoma, and I got tickets going with a buddy. So anyways, I'm like 29th, Thursday. I know it's Thursday, 29th, but today's Wednesday, the 28th. So anyways, but I'm always paranoid about that kind of thing. I don't want to miss it. So that's bond discounting. I did have a practice assignment not required or something. So maybe that will be the discussion board topic, possibly. We could have you guys talk about what you think the housing market's going to do. I was just commenting this morning. I drove by the Shell station. It's gone up 40 cents, right? That's about almost 10% just in the last 2 weeks, maybe. So I'm like, oh, my tank is half empty. I need to fill it up. And so that's 10 gallons at 40 cents is $4. It cost me $4, right? More today than it would have a week or two ago. And I'm just saying how much gas is going to be. It will shock you come November 2nd. So after the midterms, right now they're politicking the National Petroleum Reserve, which Trump filled it up when gas was super cheap. Oil was super cheap. He filled it up, even though the Democrats complained and didn't want him to do it because he said it was a big giveaway to the oil company, blah, blah. So he filled it up, maxed it out. Now Biden has sold that oil off, including to other countries. So he gave a significant share to China, other countries. Now he's selling it off with the attempt to drive down oil prices, but it's not having much of an effect. Gasoline costs exactly what it did when he started this political stunt. And so what's going to happen is now the reserves are down to about 40%, 30 or less right now. So he's gotten rid of over half of this. It's a strategic petroleum reserve. So that is, if we're in a war or something like that, then you're supposed to use it, not for midterm elections. But the point is they're trying to push gasoline prices down so that people forget about the Green New Deal, which is the idea of Rashida Tlaib been grilling bank CEOs. You can just look at that video, and she asked him, will you agree to stop drilling oil today? Stop carbon fuel. Well, she said fossil fuels. They're not fossil fuels, but they're carbon fuels. Would you agree to stop producing them today? And Jamie Dimon, rightfully so, good for him, said no, that would be the road to hell for America. And then she, of course, got giddy, and she said, "Oh, really? Well, let me tell you something. That all the people who just got loan forgiveness have money in your bank, they should take it out." And so, where are they going to put it? If they stopped drilling carbon fuels today, half of the world's population would be dead by Christmas. That's just pretty obvious, and it's because the vast majority of people rely on food from other people, right? Probably 99% of the American population, even farmers don't grow their own food, right? They grow food for everybody else, and then they trade. And all of that's done with diesel trucks, diesel tractors, trains, getting it from one point to another. None of these things can be electrified. They have electric tractors, but let's get real here. You can have an electric train. So yeah, a model electric train that I plug into the wall. Okay. So there is actually a combine harvester, because I was looking up electric tractors because it's such a ridiculous idea, but it literally has a 1 mile extension cord. No, 1 kilometer. And you're supposed to plug it into the wall and then go drive your field. So my grandma had a plug-in lawnmower, and I remember you had to be so careful not to run over the cord because it's, you know, it's an extension cord. You run that thing over, then your lawnmower won't work. But yeah, so just careful of those things. And as interest rates go up, the economy is going to suffer significantly. So you're going to see a pretty dramatic recession coming on. And most economists do agree to that. So even Larry Summers is saying that this is the Fed raising interest rates as fast as it has, given obviously rates should have been raised a decade ago. They should have gone up, but they've been so low, they've been really driving the housing and the market itself, the stock market. And so you're going to see a lot of maybe not 2008 type housing crash, but you will see housing dramatically cool off 10 or 20%. And the economy itself is going to, because of inflation and other things, is going to suffer significantly. So I would just fill up gas today. That's what I'm going to do. Although it's not going to go up $5 tomorrow, but it will go up $5 by the end of the year. So I think gas. So if you're watching this, I predict gasoline will cost about 50% higher by Christmas, by the end of the year, than it does today. So today it's 5. I think it'll be 8 probably by January. And the reason is it's the policies of the administration being very anti-energy. So they want to mandate, Seattle has a couple of years ago, mandated that you electrify your home. So no new homes were allowed to have natural gas product appliances. We have a gas water heater. Gas appliances last about 2 or more times as long as an electric one because they're just simpler. Electric water heater has an electric rod that goes into the water to heat the water, and that thing corrodes. A gas one just has a flame on the bottom, and I actually replaced that thing in ours 2 years ago. So it's just simpler. It's 20-year-old water heater. I pray it stays another 20 years or so, but electric water heater would never last that long. They estimate about 10 years. So it's environmentally friendly is the point. To be gasoline cars are far more environmentally friendly than electric cars. Just look at a lithium mine. Okay? The batteries in those cars are absolutely atrocious, environmentally catastrophic. Chile has 65% of the water resources go to the lithium mine. They are kicking Native Americans off their ancestral lands. They're going to do this in Nevada. They're going to send almost all the water in Nevada towards these lithium mine that they want to produce in the northern border with Oregon. And that's going to be an enormous drain. They're going to drop the water table 10 feet. That's the numbers. Right? And so you're looking at just massive amounts of water being polluted. And when we're talking pollution, we're talking metals and toxic chemicals that they use. And so it's also going to remove Native Americans from, my family is Native American. And so they're going to be not from Nevada, but they're going to remove natives from their lands. Ranchers are going to be kicked out, so all kinds of things, and all in the name of the environment. So they're going to destroy the environment in the name of the environment. This sounds a lot like the train, right? So the train that they've run into Seattle cut down 5,000 plus trees just to go from Seattle to North Shoreline. Very environmentally friendly that was. And who's going to use the train? Nobody. So anyways. Okay, so the point of this was the bond discounting, right? So you discount bonds over as interest rates go up, bond values go down. And again, those are values that of bonds that are on the market. So, okay, if you guys have any questions, I'll continue with more of these videos. I'll have to do like a Zoom thing with going over the book and doing some of the financial math equations, because I'm not sure if I have those yet. So, okay, you'll see me soon. All right, take care.